Now we are going to discuss the nature of insurance. The first characteristic is contract. Insurance is a contract between insurer and the insured. The insurance contract is always made in written. It must contain all the essentials of a valid contract. So, all the terms and conditions are written in the contract and are accepted by both parties, insurer and the insured. The next point is sharing of financial risk. It is a technique to share the financial loss that might fall on an individual on the happening of an event. The event may be a death of a family member, loss of an asset due to fire or accident. Good faith. The insurance contract is based on the principle of good faith, whereby it is agreed by both the parties to disclose all the important facts before signing the contract. Contract of indemnity. All the contracts of insurance are contracts of indemnity except life insurance. The payment is made on the happening of a certain contingency insured. Whenever the contingency occurs, the payment is made. It may happen that a person has made a contract with the insurance company for a loss of fire, but the fire may not be held in the future time. So, in case of life insurance, the death of a person will certainly occur. So, the payment is very certain in case of life insurance. So, life insurance contract is also called a contingent contract. Large number of insured person. To spread the loss to many parties, the insurance company tries to focus on large number of people under one contract so that the contract becomes cheaper for the insurance company. Insurable interest. No person can make or enter into a contract unless he has insurable interest in the object or the life insured. Transfer of risk. Insurance is a device in which the insured transfers his risk to the insurer, that is, the insurance company. There are two types of classifications in case of insurance. The first one is life insurance and general insurance. General insurance consists of fire, liability, marine, motor, social, health, and home insurance. Life insurance is insurance to human life. General insurance includes fire insurance, which is an insurance to a property which can cover damage and losses caused by fire. It helps to cover the risk of loss of property caused by the fire accidentally or unintentionally. Marine insurance covers the loss or damage of ships, cargo terminals, and any transport by which the property is transferred, acquired, or held between the points of origin and the final destination. Motor insurance is also called automotive insurance. It is a contract by which the insurer assumes the risk of any loss the owner of a vehicle may incur through damage to property or persons as the result of an accident. Social insurance is a public insurance that provides protection against economic risk. It is considered to be a type of social security. It is provided economic security to weaker sections of the society who are unable to pay the premium for an adequate insurance. Health insurance is known as medical insurance. A person acquires healthcare coverage in the advance by paying premium. Home insurance is a type of property insurance that covers losses and damages to an individual's house and the assets in the home. Liability insurance is known as third-party insurance. It is a part of the general insurance system of risk financing to protect the insured from the risk of liabilities imposed by lawsuits and similar claims and protections the insured if the purchaser is sued for claims that come within the coverage of the insurance policy. Now, we are going to study the next topic, fundamental principles of insurance. These are the 7 principles of insurance that are going to be studied in the later slides. The first principle states the principle of utmost good faith. Both the insured and the insurer should have good faith towards each other. They should disclose all the necessary information before signing the contract of insurance. Insured must provide complete, correct, and clear information to the insurer. It applies to all kinds of insurance contracts. The individual getting insured must willingly disclose the information to the insurance company with true information relating to the subject matter of the insurance. For example, an insured is getting into a contract with the insurance company for life insurance. So, it is the responsibility of the insured or the person who is getting his life insured should give in detail each and every disease which he has so that the insurance company can come into a contract with the correct information. The next principle is principle of insurable interest. The person who is getting insured under the contract must have some financial loss by the damage of the insured object. It means the person should have insurable interest in the object which is getting insured. Principle of indemnity. Again, principle of indemnity states the insured getting the security, protection and compensation against the damage, loss or injury. All the insurance contracts are contracts of indemnity except for life insurance, and the compensation must not be less or more than the actual damage. The merits of principle of indemnity are avoidance of under or over insurance. There will be a tendency on the part of the insured to get things overvalued. Since in insurance only the actual loss is compensated, so the insured would be discouraged to under or over-evaluate the policy's amount. Principle of contribution. The insured can claim the compensation only to the extent of actual loss from any one insurer or all the insurers. So, the actual total loss is covered by the insured, but he can take the compensation either from one insurer or he can take in proportionate amounts from all other insurers. The insured cannot claim the compensation from other insurance companies and make a profit if he claims full amount of compensation from one insurance company. Principle of subrogation. According to this principle of subrogation, after the insured is compensated for the loss due to damage to property insured, then the right of ownership of such property transfers to the insurance company. The insured can claim the amount from the third party responsible for the loss. It allows the insurer to pursue legal methods to recover the amount of loss. For example, if you get injured in a road accident due to reckless driving of a third party, then the insurance company will compensate your loss and will sue the third party to recover the money paid as claim. Principle of loss minimization. According to the principle, insured must always try his level best to minimize the loss of his injured property. He must take all possible measures and necessary steps to control and reduce the losses. He must not neglect and behave irresponsibly during such events just because the property is insured. Principle of causa proxima. It means the nearest cause or the closest cause of loss. When a loss is caused by more than one cause, then the nearest cause should be taken into consideration to decide the liability of the insured. So, these were the 7 principles of insurance. Thank you.